So I think there's a possibility that he will try to ride two horses with one ass again, as Powell did, in a different manner next week by rolling out this same fairy tale that we can have disinflationary growth, that we can have higher growth, but that the higher growth won't necessarily drive higher rates. I think it's total BS. I think it's a fairy tale. So let's see what he does. One way or another, we're gonna find something out next week. And so I think they're gonna have to show us a bit. They're gonna have to show us some cards next week. And I think that makes it an important meeting and an important setup for the back half of the year.
Financial markets are at a critical juncture as investors try to understand the future of inflation, interest rates, economic growth, and the global monetary system. With central banks facing difficult choices and geopolitical tensions adding uncertainty, many analysts believe the second half of the year could bring major changes. Luke Gromen, a respected macroeconomic strategist known for analyzing global liquidity, sovereign debt, and monetary policy, argues that policymakers are trying to convince markets that strong growth can coexist with falling inflation and stable interest rates. He explains that the real challenge is balancing economic expansion, government debt burdens, and inflation pressures without damaging bond markets or weakening confidence in the financial system. According to his view, expectations surrounding upcoming Federal Reserve decisions could reveal whether policymakers have a realistic solution or are simply delaying a larger reckoning. He also highlights concerns about global trade realignments, rising energy costs, and pressure on major economies that could benefit hard assets such as gold. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Yeah, I think next week is going to be a big card flop, if you will, to use a poker term. He's going to have to show us our cards, and there's a consensus on Wall Street that he's going to be hawkish. And certainly when he was at the Fed in 10 and 11, what have you, he was very hawkish. What I find it's not as well known is that he co-authored an op-ed in the Journal in December of 2018, essentially begging the Fed to stop hiking rates. People don't seem to remember that as much, with the S&P down 10% off the highs, and please stop hiking rates. Now is not the time. So I think we're going to get a big card flop in terms of getting his view. Now, that big card flop might be, he wrote another op-ed in the Journal about the Fed last fall that I think was kind of his job interview, so to speak, for Trump, in which he said, essentially, one of the things, he criticized the Fed, but from an economic policy standpoint, one of the things he said that I thought might be important as it relates to next week is, essentially, we can grow out of this in a disinflationary manner. And he basically said, if we invest in AI and technology, that will drive growth up, and growth that will not, it will be disinflationary like the 1990s. And that's the way we can sort of square the circle between what otherwise seems to be a completely untenable need to either sacrifice the dollar, inflation, or the bond market, higher rates. And so I think there's a possibility that he will try to ride two horses with one ass again, as Powell did, in a different manner next week by rolling out this same fairy tale that we can have disinflationary growth, that we can have higher growth, but that the higher growth won't necessarily drive higher rates. I think it's total BS. I think it's a fairy tale. So let's see what he does. One way or another, we're gonna find something out next week. And so I think they're gonna have to show us a bit. They're gonna have to show us some cards next week. And I think that makes it an important meeting and an important setup for the back half of the year. I think next week's gonna be really important because we're gonna get some semblance of where we are. Because to your point, this looked like a relatively easy job when he said yes. And now
Yeah.
it is a flaming bag of dog poo that he's got to try to put out without getting his shoes dirty. Two biggest Asian trading partners heading since last October toward a debt crisis, which will pull down everything else in the world and certainly in the West, but China's going to be hurt by that too. And it just keeps getting, and then you layer the oil situation on top of it, which is worst for Japan, certainly way more than China. And then the Chinese don't like what's coming out of the Japanese in terms of the more sort of militaristic rhetoric. And so they're cutting off rare earths. They are doing some other things that put upward pressure on inflation in Japan as well. And that's where I come to the part about being of two minds about it. Is this the Occam's razor is Japan and Korea are heading towards debt crises that are going to sort of, it's not good for anything except maybe the dollar in the short run and ultimately really, really good for gold. Or was there some sort of deal agreed to? Was sort of the divorce papers between the U.S. and the Chinese manufacturing base sort of put in front of both parties in Busan in October, and general framework around the divorce. And then the U.S. went to Japan and Korea and said, listen, we're talking about reshoring, but there's no freaking way we can reshore to America. It's all bullshit. We're going to do some stuff here, but we can't reshore that much here. We don't have the labor. We don't have the infrastructure. We don't have the grid. We don't have any of it. So we don't have the engineers. We don't have the welders. So we're going to do what we can, but the lion's share of American reshoring is actually going to be, make Japan great again and make Korea great again. But Japan and Korea, if we switch manufacturing from China to Japan and China to Korea, our costs go like this. So we can't without blowing up our bond market. Unless we do a deal with you, Japan and Korea, which is you guys kill your currencies, kill them. And in return, we will give you sweetheart no bid deals for factories here in the US, preferential market access, etc. And that is sort of financial warfare in the other direction, right? That's, hey, we're going to cut China out of the mix everywhere we can, and we're going to move it to Japan and Korea. And the only way that works is if they kill their currencies. So, the cost pickup isn't like this. It's, here. Maybe. I mean, that's at the very high level. There's still practical things, supply chain things that make that highly challenging at best, and certainly anytime soon. That's how I think about the financial warfare is absolutely happening, whether it's U.S. sanctions here, there, and everywhere, whether it's China sort of, doing what it does. They've weaponized gold 3 years ago to defend the yuan, in my opinion. You can see them still buying in. It's another sign. China's buying just more and more gold as gold goes down, which is, again, 100%, 180 degrees opposite of what everyone said was going to happen 3 months ago. Oh, China's screwed. They're going to have to sell their gold. Well, they're just buying more and more. So you're wrong about something the same way I was wrong about, the fact that Hormuz being closed for I was right about Hormuz being closed for much longer. I was wrong that how quickly it would break. I'm certainly right about that, but I was wrong about that to be clear. So,
yeah.
Anyway, it's not an answer, but it's a framework of sort of how I'm thinking about it, because I don't know that there is an answer yet. Yes, there's warfare going on.
Yeah.
What are the terms and conditions? And we can see signs in the markets. None of it's great for risk assets, in my opinion, but, let's see.
A key concern is the belief that technology investments and artificial intelligence can generate enough productivity gains to offset inflationary pressures. While this narrative has gained popularity, skepticism remains about whether such growth can occur without pushing interest rates higher. If economic activity accelerates while debt levels remain elevated, governments may face increasing financing costs that challenge fiscal stability. Another important factor is the changing structure of global manufacturing. Efforts to reduce reliance on existing supply chains could increase production costs and push prices higher. At the same time, tensions between major economies continue to influence commodity markets, energy flows, and industrial production. These developments create uncertainty for policymakers attempting to maintain financial stability while supporting growth. As markets evaluate these forces, investors are paying close attention to signals from central banks, bond markets, and precious metals for clues about the next phase of the economic cycle. Now, let's get back to the interview.
Look, you can buy dollars or you can buy oil. And you can't put oil. My wife's truck doesn't run on dollars, it runs on oil. And last week I put $158 in it. So, the issue is ultimately, you need energy and food. They're higher on Maslow's hierarchy of needs than you need treasuries, US dollar stocks, etc. And so market action of dollar down, bonds down, stocks down is capital flight. That's money leaving the dollar. Where's it going? Well, it's probably either, buying commodities or paying down debt. I'm really surprised or alternatively, some of it might be, if you look at the volumes of CIPS, China's international International Payment System, Interbank Payment System. I can't remember what the I is. Anyway, I think it's Interbank Payment System. Point is the volumes in this war have exploded higher. In other words, to get around U.S. dollar sanctions, etc., there's a lot more volume going through that. Now, is that enough to drive the dollar like down with risk off as sharp as it is? Boy, I'd be surprised. So it is, at the end of the day, capital flight. It's capital flight price action. Dollar down, bonds down, stocks down. Again, we're flat on the dollar, so it's not quite there. But we saw this in Liberation Day. We saw capital flight. Dollar down, stocks down, bonds down in post Liberation Day for a week or two, and then Trump was had to come to Jesus from or the hey MFer call, as we used to talk about on the sales desk. Hey MFer, knock it off. And 7 days later he paused. But it is, as it relates to Warsh, it makes his job infinitely harder because again, there's all this noise, all this food, or all this word salad, all this. It's a very simple choice: the dollar or the bond market. They have to make that choice. They're going to have to sacrifice one. All of this really just brings it forward. It's not, it was, 3 months ago before this silliness, Warsh, like you said, is pricing cuts. Warsh had some time to think about it. Now, next week, he's going to say something and it's going to become, what do you want? You're going to let rates rip or are you going to let the dollar fall? What's going to happen? First principle about Donald Trump is what? He is going to pimp that thing like it is the greatest deal since the Magna Carta or the signing of the Declaration of Independence. So if, as you said correctly, since then it's just faded away to nothing, what's this tell us about how that meeting went? The next data point that we can point to factually, China's imports of oil are collapsing. They're down like 4 or 5 million barrels a day. So like all of this stuff about we can get around it, the number one driver to making the reason why the oil markets have not done this already has been China's ability to drop its imports by a staggering 4 to 5 million barrels a day and not economically collapse. If you'd have told someone, hey, China's going to drop oil imports by 4 to 5 million barrels a day, what's their GDP do? If you'd have said that three months ago, they'd been like, oh my God, China's going to have a severe recession. I just read something from Jeff Curry earlier today that I believe the amount of charging, I don't know if it was charging stops or wattage used or what it was. I'd have to go reread it. But the bottom line is up 55% year over year in China. So basically, they've got the grid, they've got the EVs, they've got the infrastructure. And so like, we'll just drive electric. We don't care.
And they've been stockpiling like crazy.
They've been stockpiling like crazy. So I think that's part of it too, that they probably had more. I think they had 1.8 billion barrels in an SPR, 1.4 billion barrels in an SPR, which is way more than anybody, but they may have had more than that even. But we can see what they've imported. We can see they're not collapsing. We can see, the adjustments they've made in terms of what they're driving. But I don't think people have thought hard enough about the potential implications of that. It's particularly in the context of China's screwed more than anybody, which was overwhelming consensus 3 months ago. Overwhelming consensus, which is China wants this thing to last longer. China's fine. China's playing a strategic game here rather than some sort of tactical game, which is leave it closed. Leave it closed. We know what's about to happen to the U.S. bond market, to the British bond market, to the EU bond market. It's all about to blow up. Leave it closed. Great. Now, would that explain why they sat down and nothing came out of it after from Donald Trump? Oh, I bet it might. So to me, these are both huge non sequiturs, right? The fact that Trump didn't say anything about it, brag anything about it, ongoing. So we know that it was not a great meeting for Trump. And this drop in Chinese imports without China collapsing tells us, A, they have more flexibility than even I would have thought, but certainly more than everyone that said that China was screwed 3 months ago by the U.S. actions vis-a-vis this blockade, that they might be happy letting it go on. I would add a third one sort of in the context of that blockade that you're mentioning, which is they think that, I believe it was the second F-15 might have been shot down by a shoulder-fired missile, Chinese shoulder-fired missile, which was another non sequitur, right? What did we hear when this started? Oh, Chinese weapons are crap and the Chinese didn't do anything to help the Iranians. Well, that F-15 didn't kill itself, right? It didn't shoot itself down. U.S. Pentagon officials, again, citing NBC citing Pentagon officials saying it was a Chinese shoulder-fired missile. And that the Chinese had provided high-end radars, long-range radars that were detecting U.S. stealth technology. That was at the bottom of the article. And then we layer in things like, hey, the Russians are shipping stuff into Iran from the Caspian, and that the Chinese are doing it via the rails. And again, the Caspian volumes, the rail volumes, they're not nearly enough to overcome the entire blockade. But this is all a relative game. It's a pain contest, and those are essentially morphine shots to Iran in a pain contest with the U.S. And so, I look at that China meeting in the context of all of that. I think they talked about some things, but I don't think I don't think it necessarily achieved what the U.S. was hoping that it would. And I think what we've seen since is I think the Chinese basically said, "Listen, you made your bed, now sit in it. You're now lying it. You want that straight closed? Keep it closed. Great. Let's see what happens first."
The debate centers on whether policymakers can successfully navigate a world of rising debt, geopolitical fragmentation, and persistent inflationary pressures. Many investors believe the traditional economic playbook may no longer be sufficient because government deficits, aging demographics, energy constraints, and supply chain restructuring are creating challenges that did not exist in previous cycles. If growth slows while debt continues to expand, authorities may eventually be forced to choose between protecting financial markets and preserving the purchasing power of currencies. Such an environment has historically increased interest in tangible assets, particularly gold, as investors seek protection against monetary uncertainty. Any disruption in global trade or energy markets could further complicate efforts to control inflation. The coming months may therefore prove decisive for both policymakers and investors. Decisions made by central banks, combined with developments in international trade and fiscal policy, could determine whether markets experience stability or renewed volatility. Understanding the interaction between debt, inflation, growth, and monetary policy will remain essential for anyone following the global economy and precious metals markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.